I want to talk about some of these leading indicators or indicators that you're paying attention to say, hey, this run might come to the end. I hear what you're saying about, there being a lot of room to run to the upside on the S&P, on gold, on crypto, Bitcoin. One thing I heard you say in an interview that I hadn't heard anybody mention before was you were watching Singapore as a leading indicator for a market top. I'd love to hear your rationale on that. But then also, you mentioned the dollar, the DXY bottoming out as a sign that the run is over. And if the dollar shoots up in value, all these other assets will come down. Do you have a target for the DXY in terms of a bottom? Do you think it'll get to 90? Or are you just watching for when it does bottom and turns around, and that's the signal you're looking for? Just walk us through some of these leading indicators that you're using here.
So the dollar is telling us, first of all, you would not have had this kind of move if the dollar was above 100 or something like that. So you probably see that the dollar now will continue a little lower here. And I start at 90, not seeing that at all. I see around actually 95 to 96 is probably not as low as 95. So we're actually just in the final phase of this. This can be a more drawn out kind of process as I see it technically. So you'll probably see that it goes on for another month or a month and a half even, but and it will be a downward trend, but it'll be more muted. What you will see is that the euphoria or the negativity on the dollar is going to rise, and you're going to see sentiment saying, "Oh, the dollar is just shit and will be thrown out or whatever." And that's why Bitcoin will reign and all these things. This is what we need to see, because otherwise we'll not get a big bottom in the dollar. So I'm waiting for that kind of the psychology of things is actually a great indicator by itself. But there are some levels also on the dollar, especially the euro dollar, where it's around 120. When we get there, I think it's closing in on the top, and we have to remember that the decline we have seen is actually a decline, a correction ever since the very big top we had in 22. I think it was September 22, and that people really understand the consequences of. So the Dixie, as I see it, can run to 117 to 220. On the next bull run, and that will crush all the risk assets. So they need to be careful. Leading indicators, yeah, of course, Hong Kong also, but also I come from a small economy, and we know that if Big Brother down south, Germany, gets a cold, we will get something much worse. We will get pneumonia here, and the same goes for the U.S. obviously for the rest of the world. So if the U.S. starts to see, so that's why it's good to look to small economies, because if they start to wobble and you start to see problems there, you'll see that that's actually a good sign, a good indicator. And when people were so bearish in March and April of this year, in March especially, you could just look to the Singapore index and say it's actually been outperforming NASDAQ. People were calling for a top in the NASDAQ in December. Remember that? And I was saying there was no way. First of all, you don't have a recession according to the business cycle. Secondly, how could you see that the Singapore index, which is a highly trade-dependent economy, actually outperforming the NASDAQ 3-4 months after the NASDAQ should have made a top? And this was into a trade tariff war kind of thing. It just didn't make sense at all. And hence, here we are. And I said we were going to see a V-shaped recovery, which is what we're seeing. And now people are starting to say, oh, now there's nothing stops this train. I can promise you there's a lot of things that can stop this train. So we're looking at these things, and then you can look to yield spreads. You can look to credit spreads. Then one of the things that I'm saying why I'm also still bullish is because the yield spreads, the credit spreads are not spiking to the degree I want to see. Because we need to see the short-term yield starting to drop quite fast. We don't see that at this point, and for as long as it doesn't, well, then we could easily see this go on for, I don't know, a month, 2 months, and that's why I will not call the when. I will call it the where when we get there. And I can say we can look at a few things and say, okay, now we have a certain indicator starting to flash. So people saying, oh, but you said then that no, I'm saying the levels that we need to get to, and for as long as I'm long my portfolio, I'm not calling any top. I can promise you, because then I would be persistent otherwise. So we are heading higher here, and it's just about how crazy this becomes before we see a top. And the only thing people need to understand that. This time is not different. This time is absolutely, it's different in that we have the largest bubble ever, and when it crashes, it's going to be really bad.
Okay, so there's a lot in there. You mentioned your portfolio. I want to ask some questions about that because I think a lot of people would be very interested. But I want to kind of come to this idea of the largest bubble ever. This has been going on for a long time. And you mentioned that, and a lot of macro analysts have been pointing to this too, that the Federal Reserve and central banks in general are trying to step in with a lot of liquidity to sort of like keep this bull run going, to paper over a lot of these problems. Central banks have been kicking this fiscal can down the road for decades, much farther and longer than I think most macroeconomists thought that they ever could. Why do you think that they're not going to be able to just continue to do that? Like, what is going to be the thing that blocks them from being able to just, add more liquidity and keep the Titanic afloat for a little bit longer?
First of all, there's not been a situation where they needed to taper it over since COVID. And before that, you did not have a situation since actually 2008 and since the recession. In the financial crisis, what you have seen is that the central banks have tried to sprinkle liquidity on every small problem that we have seen coming up, and what they have created is a monster in the financial market, really a monster where valuation levels are completely off the chart in terms of what would be considered normal. You have a whole crypto market that's just looking into saying, we don't care about what it creates of yields, and I'll still be speculating about this particular meme coin, and it's going to go to the moon, which it probably is, because of somebody else just coming to buy it. I mean, just the very talk of this and how it's actually being set up is the very definition of this bubble. So now you say, what is different? Why can't they just keep doing that? First of all, because now for this time around, we see, like in 2019 into the COVID situation, and in 2007, we see that the business cycle is rolling over. It hasn't done that ever since then, because they have been able to keep it going, as you said, with stimulus. This time, you're actually seeing that the consumer is now getting hit by the one thing that kills all cycles, which is inflation. So when inflation comes in, the Fed has to step in, because people then, otherwise we can see inflation keeps going up, and they do. Now that gives a double whammy to the consumer, because first of all, you saw the inflation level, not the flood of it coming in, because that's going down, but the level has risen by 20% or something since 2020. So all consumers around the world, they just faced another 20% on the cost of living. Then we also gave them a stimulus check, so they've been able to actually keep it going for some time, which is why it's taking a little longer. But inflation has been killing them. What is happening meanwhile is that the yields have been moving up. So we saw yields moving up quite a lot, which means that nobody can afford to buy a home these days. So if you look at the home sales, the existing home sales in the US, it's actually in the gutter, even though unemployment rates are really low at this point compared to other times when we were at similar levels. So everybody's sitting there with a job. They can't really sell their home and they feel the squeeze of that, which is why there's so many people in the US that can't, put food on the table, find it difficult to do that. So the situation is that this is hurting the real economy. And this is what people tend to not understand. When is the real economy hit? That's when you see these rollover of these leading indicators. You saw that in 19, where it predicted also a recession, my model. It showed that in 2007, where it predicted recession, it came, and so on. And now you see it again. You didn't see it in 22, when everybody was calling for a recession in 22. I did not. You had the leading indicators were up in the sky, and the same with the coincidence. There was no way you're going to see a recession there. Could you see a very hard pullback? Yeah, but it was not a recession. No, by any means, at all. So people are not observing the right things. People are really not looking, and that's the problem. Look to the consumers. Look at how they are struggling just to make ends meet, and then understand that by the end of the day, there's nothing else driving the economy than the consumer. You can try to drive valuation up to certain levels, and then you think you can actually get the trickle-down effect. Remember, even liquidity is meant to affect the consumer. But if the consumer doesn't buy into that, then there's nothing to do with it. Then the liquidity doesn't help. It only spirals the financial world into craziness, which is what we see right now. So we are in a situation where the crazy world, the financial world, thinks, oh, this is just going to the moon, and keeps going because the Fed is coming in. Guess what? Every time the Fed comes in, they don't do it because things are great. They come in because things are bad. And just mention one time where we have seen a rollover of the business cycle where the Fed actually saved the day. They never did. So the Fed is horribly late because they look out the rear window when they're driving, and And that's what they do again. They focus on inflation at this point where we have inflation at 2.7, 2.9, which is nothing, while we see the non-farm payrolls are just, really bad. And you see the quality of job also deteriorating, and long-term unemployment is moving up actually to higher levels that we haven't seen any time since the 1950s into 2009. It's actually rather remarkable that we have a US market that looks like that, a US labor market. So I don't know where they get it from, but I know that a lot of people that I talk to, they seem to point to the financial market. And I just say, okay, if you look at the financial market for direction, then you probably miss the top in the Nikkei 1999. You probably miss the Nasdaq, and every time this spikes up in a vertical manner, which it is doing right now. So there's a top coming, and it's going to be bad.
So I really appreciate the perspective on that. I think something that stands out to me, well, a few things. Number one, you said that the Federal Reserve, central banks are reactive, not proactive. That's very true. In history, like they come into, sort of rescue the bodies after the crash has happened, but they're not usually effective at preventing all crashes that come into the market and the economy. Another thing I think I'm taking away that I'm hearing you're saying is that you have to look at the consumer, and instead of a lot of modern monetary theorists will look at the top level, or like you said, like the biggest economy like America, but really it's smaller economies and smaller participants in the market that are the ones who feel these impacts the most severely and first, and that should be your leading indicator. Really helpful perspective shift. I want to ask a question about artificial intelligence. I've heard a lot of analysts, macro analysts, and just market participants in general talking about the huge productivity gains that are coming from AI and how that's rapidly changing the economy. I think the Trump administration has taken this perspective of trying to run the economy hot, grow our way out of these problems, and try to use artificial intelligence to do that. Do you think that there is any validity to that? Can that sort of extend how long the music plays on, or what's the flaw in that thinking or that approach to this?
I mean, I don't even understand it, honestly. I mean, just think about the logic to it. Okay, so what we're going to do is that we're going to take, let me just follow the first part of it. There are so many things, it's wrong to so many levels, so let's start out with one of them. Okay, we take artificial intelligence and put it into a business, and it increases productivity 50 times, or 50%, let's just say 50% or 100% or something like that. What are you going to do as a business then? Are you going to hire more people? No, you're probably going to lay off people, because why would you need extra capacity if there's no buying? So great that you can increase your capacity, but that means that your colleague to the right is not needed any longer. How can that increase that we're going to have a better economy? Of course it will, but down the road. But I'm talking about right here and right now. That's not going to help. That's actually going to shed people, push people out if that's going to do anything. Okay, now it sounds like I'm against AI and I think it's a bad thing. It's actually not. It's fantastic. AI is going to change the world. It's going to lift the productivity levels of the world, and it's going to create, wonders that we can only dream of today. But now let's go back in time and look at 1920, and then look into mid-1920. What did we see there? We saw the emergence of new technologies like the radio, and we saw the emergence of the car, and of electricity. Sorry, that's a difficult word to say. Electrification also. Now, just think about the productivity gains that came out of that in the 1920s. Did that prevent a blow-off top and a very large crash in the market? The answer is it did not. Now go back to 1840s, and you had the railway mania, where you also had a technology which would change the world completely. The steam engine came out. All of a sudden you could travel, from east to west in the UK. It was back then, mostly, and also in the US, obviously. But did that prevent actually to evolve into a crisis? No, it did not, because people were front running this, and it actually created a spike in the stock market. And you saw everybody thinking, you got to get a guarantee for your money here, because we have a new technology. It's coming out. It's going to be fantastic. 1840s, 1920s, and then we go to 2000, the year 2000. We saw the internet coming out. Did it change the world? 100% it did. 100%. We wouldn't be talking here, you and I, if it wasn't for that technology shift. It completely changed my world for what I would have done in my future, in my life, with the internet coming out, sitting here talking to you and others. But did it prevent that we had a bubble there? No, it did not. So the problem is people are front running these things and thinking that it will be fantastic with this new technology and it's going to save the GDP growth and so on. The problem is, yes, it's going to change the world 100%, but it's not going to save us from the other thing, because the speculation that comes in and always follows, is going to put us into a bubble. And when you can look at the bubble, you can look at the ratios and say, this is a bubble by any means. And people are saying to me, Henrik, it's because you don't understand AI, or it's because you don't understand blockchain. I do. I actually do, but I do not do not say that it's going to prevent everything, because the problem is we are already front running this. You're already front running it. So you cannot just keep this alive. That's the problem. And again, I want to also say, first thing that's happened is that actually Mrs. Johnson there is going to lose her job because he's not as effective as the AI is. Is that a good thing for the economy over the next 3 to 6 months? It's not. It's a bad thing. You actually would like to keep her on the payroll for some time because it will take a time. And if she's above 50, now I'm 50, you'll actually see that is probably one of the reasons that long-term unemployment rate is moving up. Mrs. Johnson there, probably, she was working with a typewriter back in the days in school, and all of a sudden she has to sit here and maybe she worked with a computer, and all of a sudden you're talking about AI. Do you think she can be disconnected to the labor market? Absolutely. So it doesn't just go overnight and say, oh, we'll just run it hot and we'll do all these fancy things. These are the bubble talks that you have into every bubble. And where the salvation is this silver bullet thing that comes in terms of technology, whether it's going to be the steam engine, or it's going to be the electrification, or it's going to be the internet, but it's not going to shade it in a short time frame. 20 years from now, it will completely have redefined our world. But does it prevent a 80% crash on the NASDAQ? It does not.
Want insights on what's really moving markets and how we're trading each event? Subscribe to our channel, then join the Milk Road Macro and Macro Pro newsletters. This show is for educational purposes only. Nothing we say is financial advice. Investing is risky. Never invest more than you can afford to lose.